Greetings, I'm Shaun Pruitt, Zacks equity strategist. Today I'm going to be discussing an article on monitoring the cake ratio to see if stocks are overvalued or if the bull run will continue. So this has been the fastest market rebound in history. So the S&P 500 has hit another all-time high after flirting with correction territory just 3 months ago in March, which is why it's important to see if stocks are overvalued at current levels or if the bull run will continue. So with the S&P 500 dropping more than 10% in March from its previous high of 6,144 in February, the benchmark has now rebounded and hit a new peak of over 6,180 on last Friday. So such a fast recoup in the broader market is unprecedented and can sometimes take years. That said, it's certainly a worthy topic of whether stocks are overvalued or if there's indeed a clear path for the bull market to continue. So to do so, let's take a look at the cake ratio, also known as the Shiller PE ratio, and review the bullish sentiment that's lifting markets. So notably, the cake ratio is used to calculate the price of the stock market or individual stocks relative to their average inflation-adjusted earnings over the last 10 years. So keeping this in mind, the cake ratio smooths out fluctuations caused by economic cycles, providing a clearer view of whether stocks are overvalued or undervalued based on their historical average. So just a brief overview on the cake ratio. So preluding to the market correction early in the year, many analysts, including famed billionaire Jeffrey Gundlach, had called for a market recalibration based on the cake ratio's reading of 38 times earnings on the benchmark S&P 500. So this is the second highest level ever, which is why Gundlach and many other analysts were calling for a recalibration in the market. So this clinically adjusted price to earnings ratio, which is the acronym for CAPE, has roots that date back to 1934, when David Dodd and Warren Buffett's mentor Benjamin Graham proposed smoothing out earnings over multiple years in their investment book Security Analysis, which provided a foundational idea behind the cake ratio. So retroactively calculating historical earnings data for the U.S. stock market back to 1881, the cake ratio was formally introduced by economists Robert Shiller, and John Y. Campbell in 1988. And the cake ratio gained notoriety in the late 1990s and early 2000s when Shiller warned of the dot-com bubble and that stocks were getting overvalued back then. And just as a side note, Shiller also ended up receiving the Nobel Prize in economic science for his work on the cake ratio. So following the broader market's most recent and historical rebound, the cake ratio on the S&P 500 is currently at 37.5 times. I think it was 36 times when this article was written on Friday. So which is once again well above the historical average of around 16 to 17 times. So the historical average on the cake ratio is around 16 to 7 times, but it's currently at 37.5 times. So some pundits will point out that since the dot-com bubble in the late 1990s, early 2000s, that the cake ratio has kind of hovered near 30 times. But historically, it is at around 16 to 17 times of earnings. And you have to remember, we have had some black swan type events since then, such as the financial crisis and most recently the pandemic back in 2020, which kind of indicated that stocks were overvalued and that we should kind of pay attention to this historical average of around 16 to 17 times. So again, here you can see the cake ratio last Friday was at 36 times. Now it's at 37.5 times. So bullish market sentiment. So despite the cake ratio indicating stocks are overvalued, a clear path to global economic growth has been established, with the U.S. officially reaching a framework trade deal agreement with China last Friday. So President Trump's 10% baseline tariff on most countries is set to expire on July 8th, so next week. But this has eased concerns that rattled the stock market back in March, providing a 90-day pause on higher imposed country-specific tariffs. And while this deadline is just a few weeks away, or actually next week, the Treasury Secretary, Scott Bessent, has advised that most trade deals should be done by Labor Day, which is Monday, September 1st. So allowing more time for negotiations, the U.S. has come to a trade agreement with the U.K. and is in talks with other major trading partners, including the EU, the European Union, India, and Japan. So optimistically, May's job report and inflation data, CPI, the Consumer Price Index, did add fuel to the market rebound early in the month. after coming in better than economists' expectations. Meanwhile, reports on the Israel-Iran truce were able to sustain this optimism. It is noteworthy that literally at the time of this writing on Friday, President Trump had gone on the record and said he is terminating trade talks with Canada. So that would be something that investors will want to monitor as far as market sentiment. So the S&P 500 price and earnings performance. So while overly bullish market sentiment can sometimes be questioned as a conundrum, investors should know that usually this preludes to higher corporate earnings, the general principle that manifests in a higher stock market. So over the last decade, the earnings from the companies in the S&P 500 have grown by over 9% annually, with the index up a bullish 200% during this period, including obviously the gains that we've recovered over the last 3 months. So here you can see the price and earnings chart for the S&P 500 over the last decade, and you can kind of see those earnings trend just continuing to go up at a 9% rate over the last 10 years. So that's, why when investors get overly bullish on the market, it's going to prelude to corporate earnings going higher, which is why the S&P 500 has performed so bullishly over the last decade. So Q2 earnings key points. So we'll end with this. So considering the stock market needs higher EPS figures to ease the cake ratio's overhyped reading, it's noteworthy that Zacks director Shiraz Mian has pointed out that S&P 500 earnings for the second quarter are currently expected to be up roughly 5% from the same period last year on 4% higher revenue. So the earnings on the S&P 500 for the last quarter Q2 is expected to be up 5% on 4% higher revenues. However, Shiraz Mian does point out that while negative revisions to Q2 estimates have stabilized in recent weeks, tariff uncertainty has caused estimates for this period to be under significant pressure relative to other periods. So this is obviously something that investors will also want to keep an eye on and monitor, with that cake ratio being at such a high reading right now, 37 times earnings on the S&P 500. So just conclusion and some final thoughts here. Inherently, for the bull run to continue, a relatively strong Q2 earnings season and better than expected corporate guidance will be crucial, with the cake ratio at a very high 37.5 times earning reading right now. So this may certainly be the case with the S&P 500 already hitting a new all-time high peak after rebounding 10% in just 3 months. Again, I'm Shaun Pruitt, Zacks Equity Strategist. I hope you enjoyed this content. For more, please feel free to visit zacks.com/promo.